The median retirement savings for Americans aged 55 to 64, the people who are literally on the doorstep of retirement right now, is $185,000. At the standard 4% withdrawal rate, that generates $7,400 per year from their portfolio. And the reason that number is so catastrophically below what anyone is planning for has almost nothing to do with personal discipline, and almost everything to do with a structural decision that corporations made in the early 80s that quietly transferred decades of financial risk onto workers who were never given a single hour of training to manage it. Let me show you the full picture. This video is about the actual data, not the polished financial planning brochure version, not the number your 401k statement shows you when the market is up. The real median, the full balance sheet, both columns. The gap between what people expect will happen and what the research shows actually happens. And the specific mechanisms, measurable math-based mechanisms that are eroding retirement security in ways most people cannot see until it's already too late to fully course correct. By the end of this, you are going to understand three things: why the average is lying to you and why that lie is expensive. What is sitting on the other side of your savings number that the retirement industry never shows you? And why the entire retirement architecture was quietly redesigned 40 years ago in a way that was better for corporate balance sheets than for yours. Let me give you the frame I'm going to use throughout. Imagine a balance sheet. Left side, assets, right side, liabilities. Any accountant, any CFO, any person who has ever read a financial statement will tell you that looking at only the left side of a balance sheet is not analysis, it is wishful thinking. A company with $500 million in assets that also carries $480 million in debt is not a healthy company. It is a company that is a bad quarter away from a very uncomfortable conversation with its creditors. Americans at 50 are running a balance sheet. Most of them are only reading the left column. For the rest of this video, every time I say left column, I mean the number that looks good. Every time I say right column, I mean the number that tells the real story. And I want you to hold both columns in your head simultaneously, because the only way to actually understand your financial position is to see the whole ledger. Let me show you how the left column is misleading you. In a few minutes, I'm going to show you something about the workforce that changes every single retirement calculation you have ever run. But first, let's spend some time with the data that everyone gets wrong, including the publications that should know better. Here's a sentence you will not find in a retirement planning brochure. The average retirement savings figure is statistically useless for most people. According to Empower's personal dashboard data, as of March 2026, Americans in their 50s have an average retirement savings balance of $1,050,000 with a median of $460,000. The financial press loves this. It sounds like the system is basically working. It sounds like the average 50-year-old is doing okay. The problem is that averages, when applied to wealth data, are about as informative as checking the average temperature of a hospital. Half the rooms are on fire, the other half are freezing, and the average is room temperature. You get a number that sounds fine and describes no one's actual experience. Here's how averages break down in practice. Averages are calculated by adding total savings of all savers and dividing by the number of people. And because a relatively small number of high balance accounts can pull the average dramatically upward, it may not reflect what most people have saved, which is why the median, the midpoint where half of savers have more and half have less, is the more useful number. But even that $460,000 median from Empower is probably too optimistic for a different reason. Empower's data comes from people who use Empower's personal finance dashboard. These are people who are engaged enough with their finances to have downloaded an app, connected all their accounts, and actively track their net worth. They are self-selected. They are, by definition, the more financially motivated portion of the population. They are not representative. The Federal Reserve's Survey of Consumer Finances doesn't have that problem. It is a randomized sample of American households. It surveys everyone, the engaged and the checked out, the savers and the people who haven't looked at their balance since the Obama administration. And according to Federal Reserve data, the mean retirement savings for Americans aged 55 to 64 is $537,000. But the median, the more representative figure, is $185,000. $185,000 at the 4% withdrawal rate produces $7,400 per year. That is the actual midpoint of where Americans closest to retirement actually stand. Now let's put that against the benchmark. Fidelity's guidance says you should have 6 times your annual salary saved by age 50. With a median annual income of $71,000, many recommend that people in this age group should have 6 times their annual salary in their retirement accounts. But despite that advice, 62% of these households report that they do not have any retirement savings. 6 times $71,000 is $426,000. Most Americans in this age group are sitting at $185,000. They are running roughly 56% below the recommended benchmark. Not a little behind, more than halfway behind. And then there is the floor beneath the floor. Of the 54.3% of US households that have any money in retirement accounts, only about 5% have $1 million or more in retirement savings. The $1 million retirement account, which most retirement planning frameworks treat as a rough entry point to adequacy, is a top 5% outcome. Not a median outcome, not even a typical outcome, a 5% outcome. Over half of American households, 54%, report having no dedicated retirement savings, according to the Federal Reserve's Survey of Consumer Finances. Yet the total 401k savings rate remained steady for a third consecutive quarter at 14.2% in the fourth quarter of 2025. And these seemingly contradictory numbers indicate that the gap between non-savers and savers is growing. That is the system. A small group of disciplined savers doing well, a large portion of the population with nothing. And the average of those two groups producing a number that sounds reassuring in a headline but describes almost no one's lived reality. Let's pause here for a second, because there is a psychological mechanism behind this that matters. People use the average as a benchmark for whether they personally are fine. If the average is $1 million and you have 400,000, you think I'm behind, but not catastrophically. If you understood that the median is 185,000 and you have 400,000, your thought is completely different. You are above the median. You are ahead of the majority. The number that gets reported determines how much urgency people feel. And the industry has every incentive to report the number that keeps people feeling comfortable, rather than the number that makes them act. That is the left column. Now let me show you why your retirement math is probably built on a foundational assumption that the data quietly destroys. Stay with me on this, because what I'm about to show you is the variable that retirement calculators literally cannot capture, and it is the variable that matters most. The assumption at the foundation of almost every retirement plan I've ever seen is this: I will work until 65. It is the single most financially dangerous assumption in personal finance. Not because it's unrealistic as a goal, but because the data shows consistently and for decades that the labor market does not share this plan. According to the 2025 EBRI Retirement Confidence Survey, the median expected retirement age among workers is 65. The median actual retirement age among retirees is 62. That 3-year gap has persisted for decades across multiple surveys. But the 3-year average gap actually understates the problem, because the gap is not symmetrical. Some people retire at 68 and pull the average toward the plan. What matters is the involuntary side, the people who did not choose to exit early. Research from the Urban Institute found that more than half of full-time workers in their early 50s eventually leave their jobs involuntarily due to layoffs or other employer-related reasons. And for those who do find new employment, it often comes with significantly lower pay, more than half. This is not an edge case. This is the median outcome. A 2024 report from the Transamerica Center for Retirement Studies found that nearly 3 out of 5 retirees left the workforce sooner than they expected. And in a 2023 survey of retiree clients, financial services company Edward Jones found that 40% were forced into retirement. 54% of retirees say they retired earlier than planned, with 82% of that group retiring before age 65. And in most cases, those are not success stories. About 38% retired early due to health problems, and 14% were laid off and chose not to find a new job. Here is the mechanism of what this does to your retirement math. You plan to work from now until 65. That is 15 years of contributions, 15 years of compound growth on everything you've already accumulated, and 15 years of not drawing down the account if you get pushed out at 58 instead of 65. And again, the research says more than half of people in their early 50s experience some version of this. You lose 7 years of contributions and 7 years of compound growth. You start drawing on the account years earlier, and you may claim Social Security early. Claiming at 62 results in a benefit that's about 30% less than your full benefit, a sacrifice that many older Americans opt for because many are forced into retirement earlier than expected. In the 2025 EBRI survey, 75% of workers said they plan to work for pay in retirement as supplemental income. Only 29% of retirees reported actually doing so. This gap has remained remarkably stable over more than 2 decades of surveys. The expectation gap compounds the savings gap. And the people who plan to work in retirement as a financial backstop are essentially writing a check that the data suggests they cannot reliably cash. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Here's the part that never makes it into a retirement calculator. Knowing these numbers and building an actual system around them are two very different things. I had this same data in front of me years ago. The median figures, the forced exit statistics, the gap between what people plan and what actually happens. And it did not change anything until I translated it into a specific mathematical framework, a dated plan, not a vague intention. That is why I built something called the Exit Code. It is a digital book built on 50 years of actual retirement data. And it does one thing. It takes maybe someday and turns it into a specific date and a specific number that you can calculate and update. Not a dream, a math problem with a solution. 2 things in it that connect directly to what we have been talking about. First, there's a chapter on what I call the 58% rule, the buffer strategy you need to build against an involuntary exit. Because if more than half of people in their early 50s leave the workforce ahead of schedule, your plan needs to model that as the base case, not the catastrophic scenario. Your current plan probably doesn't. Second, it covers the dynamic withdrawal method, which replaces the standard 4% rule with something that actually adjusts to sequence of returns risk, because the 4% rule was built on historical data that assumed relatively stable long-term real returns, and your actual retirement starts in whatever market conditions exist the year you exit. You can get it for less than 1 hour with a mediocre financial advisor through the link in the description. The math in that book doesn't care what the market did this week. That's the whole point. Now, let me introduce a second layer to this story, because everything I have described so far, the median gap, the involuntary exit risk exists on top of a structural problem that was built 40 years ago and that almost nobody in personal finance talks about directly. In 1980, 38% of private sector workers in America had a defined benefit pension, a guaranteed monthly income for life, funded and managed by their employer. Today, that number is approximately 15%. The shift did not happen because Americans became irresponsible savers. It happened because Congress accidentally created the 401k in 1978. Corporations discovered they could transfer all retirement risk to workers, while Wall Street extracted billions in fees, and an entire generation spent the 80s and 90s in positions of power as pension coverage for their successors was systematically dismantled. Here is the thing about this that people miss. The pension was not just a savings account with a company logo on it. It was a transfer of risk. Under a defined benefit pension, the employer bears the investment risk. If the market underperforms, the employer funds the gap. If you live longer than actuarial tables predict, the employer pays. The company owned the risk, and you own the predictability. Under a 401k, the worker bears all risk market downturns, bad timing, poor fund selection, and fees. Corporations captured the benefit, which is liability elimination from their balance sheet, and workers absorbed the cost, which is uncertainty, underfunding, and volatility. The man who built the first 401k plan in 1981, Ted Benna, the universally acknowledged father of the 401k, has publicly called his creation a monster that should be blown up. Think about two brothers. Same employer, same salary, different eras. The older brother worked at this company when pensions were still standard. He spent 30 years contributing his time, the company managed a defined benefit fund, and now he gets a check every single month for the rest of his life. He does not think about sequence of returns. He does not have an expense ratio. He does not need to know what rebalancing means. The company owned that problem. The younger brother has a 401k. His retirement income is denominated in his own contribution discipline, whatever the market happened to do during his specific working years. The fee structure of his plan's fund lineup, his ability to not panic sell in 2008, and his knowledge of withdrawal strategies in a tax-efficient sequence. He inherited the entire risk. One brother outsourced the problem, the other inherited it. This is the subplot running through every single data point in this video. The retirement savings crisis is not primarily a behavioral failure. It is a structural transfer of a professional level financial management problem onto people who were never given the tools or training to manage it. Now let's open the right column. I have spent this entire video talking about the asset side, the savings number, the 401k balance, the IRA rollover. The asset side, for all its problems, at least has a number you can look at. The right column gets considerably less attention, but the right column is what tells you what your actual financial position is. Here is the right column for the average American at 50. Gen Xers owe more than $158,000 on average, more than the balances of all other generations, and more than 50% higher than the average debt of all consumers. And the only silver lining is that their balances are beginning to decline slightly. But many of this generation are running out of runway as they have fewer working years to pay down these debts. According to Experian, people in their 50s have the highest average credit card debt of any age group, around $9,200, which highlights a broader trend that Generation X and Americans aged 30 and above hold the largest share of debt, including credit card debt. And then there's something that almost never gets discussed in this context: student loans carried by people in their 50s. This is not parent loans for their children's current enrollment. Americans owe roughly $1.83 trillion in student loan debt, according to federal student aid data from the fourth quarter of 2025. And at $47,857, the 6 million plus borrowers aged 50 to 61 have the highest average student loan balance of any age group. $47,000 in student loan debt, carried by people who are 50 to 61 years old, who are supposed to be in their peak retirement accumulation years. Now, hold all of this up against the savings number. If the median 50-something has $185,000 in retirement savings, and they also have roughly $100,000 in combined mortgage balance, $9,000 on credit cards, and $30,000 in student loans, the .net retirement position, the thing you would actually see if you looked at a real balance sheet, looks extremely different from the headline savings figure. I am not saying that mortgage debt and retirement savings cancel out dollar for dollar. A mortgage has an underlying asset. Consumer debt doesn't. But what I am saying is that the household cash flow picture, the monthly budget, the actual dollars available to contribute to a retirement account is substantially constrained by the right column in ways that are largely invisible in standard retirement analysis. Here's the math that makes this concrete. A household paying $700 a month toward a student loan, $800 toward an auto payment, and carrying a $400 monthly minimum on credit cards has nearly $2,000 less per month in free cash flow than a household with none of those obligations. That is $2,000 that could have been going into a 401k over 15 years at 7% compound growth. $2,000 per month is approximately $650,000 in foregone retirement accumulation. More than $600,000, not from bad investments, from debt service eating the contribution budget. You think the savings gap is the problem, but the debt load is actually the mechanism that creates the savings gap. The right column is not independent of the left column. The right column is actively suppressing the growth of the left column, month after month, year after year in ways that never show up on any retirement projection until you explicitly model them. Now let's get to the deepest layer of this problem, because I have been saving this for last, and it is the thing that makes the amused, slightly disappointed version of me come out in full force. Your financial advisor charges you 1% of assets under management per year. That is the standard fee. Kitce's research shows that 1% remains the median fee for advisors managing a $1 million portfolio. 1% sounds like essentially nothing. It's less than a restaurant tip. It's less than your state sales tax. Here's what 1% actually costs you. Imagine a $500,000 portfolio growing at a steady 7% annual return. Over 25 years, without any fees, this portfolio could grow to approximately $2.71 million. However, with a 1% fee, the portfolio would only grow to about $2.15 million, a difference of $560,000. And that difference represents not just the fees themselves, but the potential growth. Those fees could have earned year after year, $560,000, more than your entire starting balance. Gone. Not to a bad stock pick, not to a market crash, to a fee that compounded against you, silently, for a quarter century. On a $1 million portfolio, earning 7% per year gross, at a 0.2 to 5% all-in cost, the portfolio grows to roughly $7 million over 30 years. At a 1.0% all-in cost, it grows to roughly $5.7 million over 30 years. At 2%, it grows to roughly $4.4 million. The gap between 0.2 to 5% and 1% over 30 years is roughly $1.3 million on a $1 million starting balance. $1.3 million on a $1 million starting balance. That's not a rounding error. That is a house. That is a legacy. That is the difference between leaving something behind and not. Fee drag compounds exponentially, not linearly. A 0.5% fee difference sounds trivial annually, but costs approximately $59,000 over 20 years and $165,000 over 30 years on a $100,000 initial investment. The gap nearly triples between year 20 and year 30 because the compounding engine has a larger base to erode in later years. And this is all before we get to Social Security. Because Social Security, for a substantial majority of retirees, is not the supplement they were told it would be. It is the foundation. The majority of retired Americans, 78%, are reliant on Social Security to pay necessary expenses, not as a nice top-up to a fat portfolio, as the thing that covers the bills. As of August 2025, the average monthly Social Security benefit is $2,008, or $24,096 annually, according to the Social Security Administration. But Social Security benefits are designed to replace about 40% of a person's working income, not 78%. 40%, the gap between 40% and 78% is supposed to be filled by portfolio income. The portfolio that, for the median American, has $185,000 in it. At 4%, that generates $7,400 per year. Social Security adds $24,000. Total, $31,400 per year. The average American household spent $57,818 in 2024, according to the Bureau of Labor Statistics. There is a $26,000 annual gap between what the median retirement portfolio plus Social Security produces and what the median household actually spends every year in retirement. And Social Security itself is not as stable as most people assume. The most recent Social Security Trustees report found that the projected depletion date for Social Security's retirement trust fund is in late 2032, pushed up from the 2025 Trustees report estimate. If the fund is depleted as projected, Social Security will only be able to pay 78% of retirement benefits. A typical couple retiring in the year of insolvency would face a $16,500 reduction to their annual benefits, a 22% cut to the primary income source of 78% of retirees. That is not a hypothetical. That is the current actuarial projection from the Social Security Administration itself. And if you are 50 today, you reach your full retirement age precisely in the window when this becomes a live question. The magic number Americans think they need to retire comfortably in 2026 is $1.46 million. That is 200,000 more than the 1.26 million figure from 2025, and it is still a far cry from what most people have saved. The gap between 1.46 million and 185,000 is $1.275 million. That is not a savings problem you solve with one good year of contributions. That is a structural problem compounded by debt, by fee drag, by forced early exit risk, and by a retirement system that was redesigned 4 decades ago to serve corporate balance sheets, not workers' financial security. Let me make this concrete with specific numbers. Picture someone who is 49 years old. He manages a team of 12 people at a regional company. His name is Marcus. He earns $75,000 per year. He has been contributing to his 401k inconsistently since his late 20s. He reduced contributions during 2008, then started back up, then paused them again when his daughter started college. His current 401k balance, $140,000. He has a rollover IRA from an old employer, $42,000. Total retirement assets, $182,000. He is behind the Fidelity benchmark of 6 times salary, $450,000. But he tells himself he has 16 years to catch up. Now, open the right column. Marcus has a mortgage with $125,000 remaining. He carries $11,000 across 2 credit cards. He has an auto loan with $9,000 left. His wife is still making payments on a Parent Plus loan for their daughter's first 2 years, $22,000. Total liabilities, $167,000. His net position assets minus liabilities is $15,000. His actual balance sheet is barely positive. He is planning to work until 65. In that 16-year window, he intends to contribute roughly $8,000 per year to retirement accounts, which is what the math says he can afford after debt service, taxes, and basic living costs. If he hits that target every year without interruption, and if markets cooperate at a 7% average annual return, here's what he has at 65. His current $182,000 compounded for 16 years at 7%, approximately $537,000. His 16 years of $8,000 contributions compounded at 7%, approximately $223,000. Total at retirement, roughly $760,000 at the 4% withdrawal rate. That's $30,400 per year from his portfolio. His Social Security benefit at full retirement age, if he has paid in consistently, would be around $24,000 per year. Combined annual income, $54,400. His current household spending is $70,000 per year. There is a $15,600 annual gap, and that is the best case scenario. Now, model the median outcome. Marcus is laid off at 57. His company restructures. This happens to more than half of people in his position, according to Urban Institute data. He loses 8 years of planned contributions. At the moment of his forced exit, after 8 years of contributions and growth, his balance is approximately $395,000. He finds part-time consulting work but contributes nothing additional to retirement. 5 years pass. He reaches 62 with roughly $554,000. He claims Social Security at 62, the most common claiming age, which permanently reduces his monthly check by roughly 30% compared to full retirement age. His annual Social Security income, approximately $16,800. His portfolio at 4%, $22,000. Total, $38,800 per year. Against the same baseline of $70,000 in household spending, Marcus is now running a $31,000 annual shortfall every year for 20 or more years of retirement. The difference between everything goes to plan and the median outcome is $15,000 to $16,000 of annual retirement income. That is not a rounding error. That is a structurally different retirement. That is the difference between covering your expenses and deciding which ones to eliminate. Marcus is not a cautionary tale about bad decisions. He made reasonable choices. He contributed when he could. He handled real-life expenses, a mortgage, a kid's education, a period of market uncertainty in 2008. He is the median American at 50, and the median American at 50 is not set up for what they are planning. Let's come back to the two brothers. Remember the one with the pension and the one with the 401k? The pension brother is not watching this video. He doesn't need to. His company solved this problem for him. He gets a monthly check, regardless of what the S&P 500 did, regardless of what his expense ratio was, regardless of whether he panic sold in 2022. The 401k brother is Marcus. He is most people watching this right now. He inherited a professional level financial management problem, was given a menu of funds with names he couldn't interpret, told to invest for the long term, and charged fees along the way by people whose incentives were not perfectly aligned with his outcomes. The shift from pensions to 401ks was not inevitable. It was a choice. Corporations made it for very rational reasons. It eliminated long-term liability from their balance sheets and reduced the cost of managing employee retirement benefits. The risk transfer was clean and efficient from a corporate accounting perspective. The downstream consequences for workers took 2 generations to fully materialize, and they are materializing right now in the retirement savings data, in the involuntary exit rates, and in the dependency on Social Security among people who were told that Social Security was going to be a supplement, not the foundation. The only rational response to inheriting a risk is to take it seriously and manage it with the same rigor that the institutions who offloaded it were using when they made the decision, which means looking at both columns, which means stress testing the forced exit scenario, not just the optimistic one, which means auditing the fee structure before it compounds against you for 30 years, and which means not confusing the average with the typical or the plan with the outcome. 3 things to actually do with all of this. First, run the net number. Take your total retirement account balance today, subtract every non-mortgage liability, credit card debt, auto loans, student loans, personal loans. If that net number is uncomfortable, it tells you your priority order. High interest consumer debt at 20% APR is a guaranteed 20% return when you pay it off. Sequence matters. Get the right column under control before you sprint on the left column. Second, build an involuntary exit into your plan. Assume, as a planning scenario, that you will stop working 3 to 5 years earlier than you intend. Run your retirement math at 62, not 65. If it works at 62, 65 becomes a bonus, not a necessity. If it only works at 65, you have an unhedged risk that more than half the population experiences in some form. Stress test your own assumptions before reality does it for you. Third, audit every fee you are paying. Pull the summary plan description for your 401k and find the expense ratios on the funds you are in. Open your IRA and check the expense ratio on every holding. Add them up and multiply the total annual dollar cost by 30. That is your approximate 30-year compounding cost. If the number is larger than you expected, and it will be, you have a question to ask, either of your advisor or of your own fund selection. Lazy investing built more fortune than crypto memes. The system handed you the risk. The full ledger is sitting right in front of you. The only question is whether you're reading both columns. Americans in their 50s have an average retirement savings balance of $1,050,000. The median is $460,000, a gap driven by self-selection, concentration effects, and the quiet math of wealth inequality. The Federal Reserve's Survey of Consumer Finances puts the median for Americans aged 55 to 64 at $185,000. Over half of American households report having no dedicated retirement savings, according to the Federal Reserve. And more than half of full-time workers in their early 50s eventually leave their jobs involuntarily. In 1980, 38% of private sector workers had a defined benefit pension. Today, that number is approximately 15%. The data is not subtle. It is just usually only shown to you one column at a time.